Thank you all for being with me. As many of you know, the U.S. House of Representatives recently passed the so-called reconciliation bill by a vote of 215 to 214, a one-vote margin. Every Democrat voted against this bill. Almost every Republican voted for it. In the coming weeks, the U.S. Senate is expected to take the bill up. Let me take this opportunity to tell you what is in this piece of legislation. At a time of massive income and wealth inequality, this bill makes the obscenely rich, the oligarchs, even richer, while attacking the most basic needs of working families and the most vulnerable people in our society. This bill provides massive tax breaks to the richest people and largest corporations and pays for them by making gigantic cuts to Medicaid, the Affordable Care Act, nutrition, education, and other programs that are life and death for working families, the children, and the elderly.
All right. So this is your boy Humbledad back with another edition of Humbledad Podcast. We're going to be talking about the big, beautiful bill, or the one beautiful bill, or some people may say the one big, beautiful bill. Whatever you want to call it, we're going to be talking about the bill. And there are takes on both sides, obviously stating that it's good and that it's bad. And the ultimate question is this something that could hurt us or help us? And for the American people, we're hoping that it helps us. And so, what I wanted to do was to get people to hear and see exactly what the bill is saying. So, I'm going to let him play out a little bit more of what he's saying, but I also want you to hear what some of the other people are saying on the other side of the road. All right, so let's hear a little bit more. Here we go. And thanks for stopping by. Don't forget to like, share, subscribe to the channel. First, start by liking this so that the algorithm sees that you're enjoying this particular episode. Then make sure you share it. So once again, that it knows that people are in the mode for this type of content.
This bill is what Trump economics is all about. If you are rich or a large multinational corporation, if you can make huge campaign contributions, you are entitled to massive tax breaks, and Congress will give you those tax breaks. But if you are working class or poor and you can't make those large campaign contributions, you are entitled to nothing. You're not entitled to health care through Medicaid. You're not entitled to a nutrition program to feed your kids. You're not entitled to a decent education.
And so I want to look at some of this real quick. I'm going to go over here. Just give me a few moments to stop my screen and then upload the other part of what he is suggesting. Here is the big, beautiful bill. And it starts out, as you can see, this is the Committee of Ways and Means, section by section. And I went through the majority of it so that I can have an understanding of what the bill is about. But I wanted you to kind of read along with me. And so the subtitle A, Make America Families and Workers Thrive Again, Part 1, Permanently Preventing Tax Hikes on American Families and Workers, as Senator Bernie Sanders says that this is going to do damage to us. But let's see if that's true or not. So the extension of modifications of rates, current law, and that's what it'll do. It'll give you the current law, and then it'll tell you what the provisions are. And I found this at waysandmeans.house.gov. And then it was sent, I checked the internet, right? And so what I can do, instead of just reading it out, I'll put the description and the link in the comment section, or in the description. So under current law, the modified federal income tax bracket schedule and lower tax rates are set to expire after December 31st, 2025. The provisions. This provision makes permanent the modified federal income tax bracket schedule and lower tax rates created by the Tax Cuts and Job Act. The provision also adds an additional year of inflation adjustment to all brackets except for the top bracket, 37%. So as you can see, this will start in 2026. It gives you the different brackets, and then it tells you what the current law is as it relates to percentage that will come out, if you will. And then the provision. As you can see, the first tax bracket is the same, and then the other tax brackets are reduced. What does that mean? Well, you go down a little further, it tells you about the extension of increased standard deductions and temporary enhancement. Under the current law, the increased standard deduction is set to expire after the end of this year. The change that is occurring, this provision makes permanent the nearly double standard deduction created by the Tax Cuts and Job Act. The provision further increases the standard deduction by including an extra year of inflation adjustment. Additionally, for the tax years 2025 through 2028, this provision increases the standard deduction by an additional $1,000 for a single filer, $1,500 for a head of household, and $2,000 for married filing jointly. The impact of these modifications to the standard deduction for 2026, according to the filing status, is summarized below. And so, as you can see, the standard deduction will be filing status under single, head of household, married filing jointly. The current law is 8,300. If you don't understand this, it's simply saying that you will be able to deduct more as a single person, which in this case is doubled. As well, in all cases, they're double pretty much. Okay, and so you're now should be receiving more money back in taxes, but don't quote me. You can ask your local tax professional. So then you go to section 3, I would say 110003, and it says termination of deduction for personal exemptions. Under the current law, the deduction for personal exemptions is set to return after December 31st, 2025. This provision permanently rolls back the deduction for personal exemptions. So in section 110004, extension of increased child tax credit and temporary enhancement. And I remember this tax credit really helping me in the, I guess years ago, and then all of a sudden it changed, and so we'll see how this does on this one. So in the current let's see, in the current law, under the tax credit, the child tax credit will return to pre 2017 levels after 3125. So under the current law, it will return to before President Trump was in office, is what it's saying. This means that the credit amount will drop from 2,000 to 1,000 per child. The child social security number required will be eliminated. So that means that you won't even have to have the child social security number, and fewer American families will qualify for the credit as the income phase out levels return to much lower thresholds. Additionally, the 500 non-refundable credit for non-child dependents will expire after this year. Okay, the provisions. This provision makes permanent the double child tax credit of $2,000 per child, maintains the increased income phase out thresholds, and maintains the non-refundable non-child dependent credit. Additionally, this provision permanently indexes the credit amount for inflation beginning after 2026, rounded down to the nearest $100, and leaves the refundable credit unchanged. Furthermore, the requirement of the child social security number for purposes of claiming the credit is maintained and expanded upon to require the taxpayer's social security number, and for joint filers, the spouse's social security number in order to claim the credit. The social security numbers provided must be considered work eligible in order to claim the credit. So, in addition, this provision increases the child tax credit to $2,500 as opposed to the previous $2,000, all the way up into 2028. I don't see anything wrong with that. Finally, this provision allows for the election to treat income from a 501(d) organization as earned income for the purposes of the CTC. Okay, and that's the child tax credit. Uh, the section 10005, it says the extension of deductions for qualified business income and permanent enhancement. So before we get there, I just wanted you to see um, based upon what Senator Bernie Sanders is saying, he is saying that it's going to be a negative impact. But based upon, I'm curious to know what you think. Based upon what we've read thus far, what do you see in the particular bill? Uh, and we're going to go further, but I wanted to come back to Senator Bernie Sanders to see what it is that he has to say. And the thing I want you to pay attention to is if he is providing you with any level of backing other than what he is saying. And this goes for any and everybody. Okay, here we go.
Trumpism is about the belief that we live in a dog-eat-dog world where the big dogs are able to eat the little dogs. And that is the way it is. This bill would provide a $664 billion tax break to the top 1% at a time when the top 1% already own more wealth than the bottom 93%. It would provide a $420 billion tax breaks to large multinational corporations that are stashing their profits in offshore tax havens like the Cayman Islands. And by the way, this tax break makes it easier for those companies to invest in robots and artificial intelligence, with the result that they're going to be able to throw workers out on the streets. And how would Trump and the Republicans in Congress pay for these huge tax breaks for the wealthy and large corporations? Well, at a time when over 85 million Americans today are uninsured or underinsured, this bill slashes Medicaid and the Affordable Care Act by more than $715 billion.
All right. So he said a couple different things. Okay. So let's see. I'm going to stop this. I am going to go back and I'm going to read some of the things, if I can find them as I'm doing this. Let's see. Here we go. Let's see. Okay. So where he talks about the businesses. Okay. So when he talks about the people that make the most money, they typically are business owners. Okay. Some and those are your Amazons, they're your Fortune 500 companies, if you will, that actually give people jobs, right? And they have forever received tax breaks. So anybody that owns a business, the way that it has been designed from my purview is that if you have a small business, they want the small business to thrive. Depending on who you are, they want the small business to thrive, so they give money back to the small business to be able to pour back into their company. If you're a larger corporation, then you'll get even more tax breaks because you're actually generating income for the economy by paying people. So hopefully that makes sense. So section 110005, the extension of deduction for qualified business income and permanent enhancement. Under current law, an individual generally may deduct 20% of qualified business income from a partnership, S corporation, or sole proprietorship, as well as 20% of certain real estate investment trust dividends and publicly traded partnership income. The deduction is limited to 20% of taxable income minus net capital gain. Special rules apply to taxpayers with taxable income in excess of the threshold amount, which for tax year 2025 is $394,600 for married taxpayers filing jointly and $197,300 for all other taxpayers. The threshold amount is indexed annually for inflation. For taxpayers with taxable income in excess of the threshold amount, the deduction for qualified business income is limited based on one, the W 2 wages and capital investment of each relevant business, the wage and investment limitation, and two, whether each relevant business is a specified service trade or business, the SSTB limitation. Both limitations phase in over a fixed range of taxable income, that is $1,000 for married taxpayers filing jointly and $50,000 for all other taxpayers. Due to the structure of these phase ins, some taxpayers are subject to marginal tax rates close to 70%. The deduction for qualified business income is set to expire for at the end of this year. Okay. So the provisions, as you can see, it was a lot to read, but the provisions are this. The provision makes the deduction for qualified business income permanent. So what this bill is trying to do is make it to where it stays the same. Now, that could be good or bad depending on who you are. I'm assuming, because there's always pros and cons to things remaining the same, right? So for taxable years beginning after December 31st, 2025, this provision also increases the deduction percentage from 20% to 23%. So the business is going to be able to deduct more from doing their taxes. And if I were you, I would go read up on or watch videos upon this whole idea of taxes. The provision also modifies the phase in of the wage and investment limitation and the SSTB limitation. Under this provision, instead of phasing in over a fixed range of taxable income, these limitations phase in at a fixed rate. Specifically, for each dollar of taxable income over the threshold amount, a taxpayer's deduction for qualified business income is reduced by 75 cents until both limitations are fully phased in. This change prevents taxpayers from being subject to marginal tax rates close to 70%. Additionally, this provision modifies the calculation of the threshold amount by adding an additional year of inflation adjustment. This provision also makes certain income of business development companies, as defined in the Investment Company Act of 1940, which is eligible for the qualified business income deduction. So, once again, I am just reading what it is currently stating as the rule applies. Okay. And then I want you to connect it to if you agree or disagree in the comment section of what is currently stated and what is going to go into. What's your thoughts and your perspective on this? Okay. We'll read this last one and then we go back to the video. Okay. Section 11006, extension of increased estate and gift tax exemption amounts and permanent enhancement. The current law says under the current law, the increased estate and lifetime gift tax exemption amount is set to expire in 2025, at the end of this year, 2025. This provision permanently extends the estate and lifetime gift tax exemption, increases the exemption amount to 15 million for single filers, $30 million for married filing jointly in 2026, and indexes the exception amount for inflation going forward. Okay, so there you have on that particular part. There's an estate and a lifetime gift tax that you can give to somebody, and you can be exempt, or you can, and so by exempting more, that means that you're able to keep more of it. Section 11007, the extension of increased alternative minimum tax exemption and phase out thresholds. Under the current law, the increased individual alternative minimum tax exemption amounts and exemption phase out thresholds are set to expire for taxable years beginning after this year, 2025. The provision permanently extends the increased individual alternative minimum tax exemption amounts and exemption phase out threshold. Okay. Let's see. In the section 11008, I think we'll come back to, well, we'll read this and then we'll go to Bernie. Extension of limitation on deductions for qualified residence interest. Under current law, the deduction for qualified resident interest, also known as the home mortgage interest deduction, which is a big deal for those that are buying houses and selling houses, is set to increase from the first $750,000 in home mortgage act, home mortgage acquisition debt to $1 million after 2025. The provision permanently lowers the deduction for qualified resident interest to the first $750,000 in home mortgage acquisition debt. So it won't increase to that $1 million. So what he's saying is that it will make it worse for us as individuals. So let's remove that. Let's bring Bernie back into the fold. and listen to what he has to say. And as we're going through this, I would really be interested in, once again, making sure that you write in the comment section what your ideas are based upon what you have been reading and hearing. And so I wanted to read it to you firsthand and get an idea of what's going on, uh, based upon what's being read. And also, if you want to be very much meticulous or detailed, you can also go to congress.gov and type in the one big bill, one big beautiful bill, and you can look at this yourself. So we're going to see what else he has to say.
The Congressional Budget Office, the CBO, has estimated that this bill would eliminate health care for 13.7 million Americans. Almost 14 million Americans would lose their health care. Further, at a time when 22% of our seniors are trying to survive on less than $15,000 a year, and I don't know how anybody survives on that, this legislation will make it much harder for seniors to receive the care they desperately need in nursing homes. And here is something else that is really quite shocking. Just this week, Yale University and the University of Pennsylvania estimated that if this bill is enacted, over 50,000 Americans will die unnecessarily due to the massive cuts to Medicaid and the Affordable Care Act. It's not rocket science. If people don't have access to health care and can't get to a doctor when they are sick, many will die unnecessarily.
All right, cool. So I do believe that people should have the opportunity to have health care, which we all have opportunity to have health care. The prices are astronomically high in my estimation, whether you're paying out of pocket or you're having to pay on a monthly basis. I know for me, at the family size that I have, it would take almost 20% of my annual income uh, to pay for everyone in the field that I'm in, and I'm in education. So there are some places where they actually pay a large percentage of the healthcare. Now, what he's talking about is Medicaid and Medicare, and he says that it's being reduced, which is true, but he doesn't explain or read anything necessarily of what is being reduced. So I wanted to try to find that in here and just in the bill particularly. Let's see. So I went to to find invest. Okay, this is part three. Invest, and I just scrolled down. Investing in health of American families and workers, and this is in section 110201. Treatment of health reimbursement arrangements integrated with individual market coverage. So that is the name of the bill. I'm sorry, that's the part of the bill, the title, obviously. Under the current law, employees with a health reimbursement arrangement, the HRA, health reimbursement arrangement, offered by their employer can use this tax advantage arrangement on certain medical expenses. Final regulations from 2019 expanded the use of HRAs, allowing employers to offer individual coverage HRAs, which, in addition to existing medical expenses, can also now be used to purchase qualified health insurance, on the individual market without violating group health plan requirements. I know for me, my family, the plan that they had for Obamacare really wasn't working. There are some other plans that may work better, but they cost as well, for a middle class family, I would say. Let's see. And then the provision for the new one, it says this provision codifies the final 2019 regulations permitting individual coverage, HRAs, and renames the policy as custom health option and individual care expense, also known as choice arrangement. So they want to give you choice in how you do your health care. So participants in choice arrangement eligible for purchase of exchange insurance under cafeteria plan. The current law generally, see if I need, let's see. I don't know if I should have already done that, but here we go. Generally, employers cannot reimburse employees for health plan premiums purchased through an exchange if any of the premium could be paid through salary reduction. Think about that. This rule makes it impossible for employees to offer individual coverage, HRA, while also allowing the same employees to use a cafeteria arrangement to pay for the balance of the plan's premium. This provision permits employees enrolled in a choice arrangement to use a salary reduction to pay for health plan premiums purchased through an exchange. So they're saying that you could pay for your health care by having a reduction in your salary. That's what that I believe that's what they're saying. If I'm not right, then you're welcome to correct me. And so in section 110203, employer credit for choice arrangement, there's not currently one, but the provision creates a 2-year tax credit for small businesses with fewer than 50 employees offering coverage through choice arrangements for the first time. The general business credit amount is $100 per employee per month in the first year and $50 per employee per month in the second year. Section 110204, individuals entitled to Part A of Medicare for reason of age allowed to contribute to health savings account. Health savings accounts really help a lot of people. The current law, individuals entitled to Medicare Part A are ineligible to contribute to a health savings account. I'm aware of that, even if they are still enrolled in a private high deductible health plan. HDHP. This provision allows working seniors who are eligible for Medicare Part A, but enrolled in a high deductible high health plan to continue contributing to a HSA. The current guardrails that apply to individuals that are under 65 and are contributing to the HSAs will continue to apply to this population, including a penalty on non-qualified medical expenses purchases. That's going to be, I think that's going to be positive. What do you think? Okay. Do you think it's going to be positive or negative? The treatment, this is section 110205. Once again, I am just going through and reading what the one big beautiful bill says, and I'm doing it section by section. And some of my commentary, I'm just saying the things that I see or have encountered, and I want you to have a chance to go through it as well. These are my thoughts, but once again, you're entitled to your own, and I welcome you to state what you say or what you believe in the comment section. All right. Here we go. In section 110205, treatment of direct primary care service arrangements. The IRS, or the Internal Revenue Service, currently has indicated it views certain direct primary care arrangements as a separate and additional form of health insurance coverage, therefore incompatible with HSAs, which can only be offered alongside an HDHP. So for those that know don't know what that means, is that basically you cannot use the HSA with everything. That's what they're saying. Okay. As far as with direct primary care. Okay, this provision allows individuals with HDHPs to also enroll in DPC arrangements and maintain their health savings account, and allows health savings account funds to be used to pay for DPC. Okay, that's the direct primary care services. So if you have money that's on an HSA account, then you can pay for direct primary care in this particular bill. Okay. HSA distributions for DPC services cannot exceed $150 per month for individuals or $300 per month for family arrangements, adjusted annually for inflation. In section 110206, allowance of bronze and catastrophic plans in connection with health savings accounts. Under current law, some bronze and all catastrophic health insurance plans have maximum out-of-pocket costs that exceed IRS defined limits for HDHPs, disqualifying HSA compatibility. Sorry. This provision allows all bronze and catastrophic health insurance plans to on the exchange to be eligible plans for the purpose of making HSA contributions. Okay. So these are a lot of different things as it relates to the healthcare system that they are saying that, or Bernie is saying that is a negative. And so if you believe that, please put that in the comment section. Whether you agree or disagree, tell me what you think. Let me go back to Bernie. We're going to I'm gonna come back to this, and I'm gonna have another video where I go through and continue reading these parts and these sections of what Bernie and the Democratic Party are saying is not good for it's not good for the American people. And I question why they say that. And let's see. And this is Bernie continuing. I think it's much more of a scare tactic, but I would really like for you all to read the bill yourself.
But it's not just our healthcare system that would be devastated by this legislation. While this bill provides massive tax breaks to billionaires, it would cut $290 billion from nutrition programs and would literally take food away from more than 2 million children and at least 250,000 low-income seniors. Recently, as you may have seen, on the TV program Meet the Press, Speaker Mike Johnson said that there was a quote-unquote moral component to this bill, a moral component. He was referring to the fact that this bill would require Americans to prove that they are working at least 80 hours a month before receiving Medicaid or food stamps. Let us see how quote-unquote moral that requirement really is. Last year, some 20 million Americans were either laid off or fired by their employers. They lost their jobs. And in our dysfunctional and cruel healthcare system, when you lose your job, you lose your healthcare. And that is what Medicaid is supposed to be all about.
I challenge you to go find out what Medicaid is for. If Medicaid is for people that are already working or people that are not working, is it for a particular age group of people, or is it for all age groups of people? But like I said, we're going to continue this conversation. I'll pick up at the 6-minute mark. Don't forget to like, share, subscribe to the channel. And this is just part one of reading through the bill, the one big, beautiful bill. And so I look forward to connecting with you on the next video. Until next time, we out here. Deuces.
The boy is dangerous.
Bad feeling about this.
You don't seem to understand something.
The thing that I like most about being a dad is that I see that I'm about to impact the world.